You know that feeling when you wake up and before you've even had your first cup of coffee, you're already reaching for your phone to check if the market is up or down? And then depending on that number, that one little percentage point, your whole mood for the day is basically decided for you. You feel okay if it's green. You feel that low, quiet dread if it's red. And if it's really red, you spend the rest of the morning pretending to read the news, but actually just refreshing your portfolio every 15 minutes like somehow that's going to change anything. If you're retired, or close to it, that feeling is so much worse, because it's not abstract anymore. It's not, oh, my future self will deal with this. It's your money right now, the money you worked 30, 40 years to build. And every time the market throws one of its little tantrums, it feels like someone is literally reaching into your retirement account and taking something from you. I've spent a lot of time, honestly, probably too much time, thinking about this. My name is Macro, and I kind of became obsessed with the psychology of money after watching my own parents go through retirement in two completely different emotional states, even though they had similar savings. My dad spent the first 3 years of retirement glued to CNBC. My mom spent those same 3 years gardening, traveling, and occasionally glancing at her account like it was a mildly interesting piece of mail. And the wild thing? Their financial outcomes weren't that different, but their experience of retirement? Completely different worlds. That always stuck with me. So I started digging, talking to financial planners, reading the research, and most importantly, talking to actual retirees, people who'd been through 2008, through COVID, through the volatility of 2022, and now through everything 2026 has been throwing at us. And what I found surprised me. The smartest, most financially secure retirees I talked to had basically stopped worrying about the market. Not because they got lucky, not because they were rich enough to not care, but because they'd fundamentally changed the way they thought about their money, their time, and what financial security actually means. And that's what we're going to talk about today, because I think some of what these people figured out could genuinely shift something for you. Not just how you manage your money, but how you feel about it, which honestly might matter even more. Okay, so let's start with what I think is the single most important mental shift that separates stressed retirees from calm ones. And it sounds almost too simple when I say it out loud, but bear with me. Most people think of their retirement as a pile of money. Like there's this big number sitting in an account, and that number goes up and down with the market, and your job is to protect that number, grow that number, and slowly spend it without running out. And when the market drops, the number drops. And that feels like a crisis because the number is smaller now. But the smartest retirees I've come across don't think about retirement as a pile of money. They think about it as a series of income streams. And that one shift from thinking about wealth as a number to thinking about it as a flow changes everything. Here's a simple way to think about it. Imagine you own a rental property. The market crashes. Does your tenant stop paying rent? No. Your monthly income from that property just keeps coming in, completely independent of what the stock market is doing. Now imagine you have a pension or Social Security or a well-structured annuity or dividends from a diversified portfolio. Same idea. The income flows. The market noise becomes, well, just noise. I talked to a woman, I'll call her Sandra, who retired in 2021 with about $900,000 in savings. When the market dropped hard in 2022, she watched her portfolio shrink to around $720,000 on paper. She said she barely slept for a month. She was checking her account constantly, second-guessing every decision. It was miserable. Then her financial advisor sat her down and walked her through something she'd never really focused on before, her actual income. Social Security was covering her basic expenses. A small pension from her old job covered utilities and groceries. Her portfolio only needed to fill a small gap. Even if the market stayed volatile, her income was stable. Her lifestyle wasn't actually threatened. The number was down, but her life was fine. She said it was like someone turned a light on in a dark room. The market could do whatever it wanted. Her income was steady. The actionable piece here is this. Sit down and map out your income, not your net worth. What comes in every month regardless of what the S&P 500 is doing? Social Security, pensions, rental income, part-time work, dividends from bonds or stable dividend stocks. Map it all out. and then compare that number to what you actually spend. When you see that your essential expenses are covered by reliable income streams, the market's daily mood stops feeling like a personal attack.
Okay, so this one I find genuinely fascinating because it works not just financially, but almost neurologically. It's called the bucket strategy. And a lot of people have heard of it, but I don't think most people truly appreciate why it actually works. Here's the basic idea. Instead of having one big pool of retirement money that all feels equally vulnerable to the market, you mentally, and sometimes literally, divide your money into separate buckets with different purposes and different time horizons. Bucket 1 is cash, or very stable liquid assets. This covers your living expenses for the next 1 to 3 years. It doesn't go in the market, it doesn't grow much, that's fine. Its job is to sit there calmly and make sure you can pay your bills no matter what the stock market does tomorrow, next month, or next year. Bucket 2 is medium term, maybe 3 to 10 years out. A mix of bonds, dividend-paying stocks, more conservative investments. It grows a little, it refills bucket 1 as bucket 1 gets spent down. Bucket 3 is long-term, 10-plus years of growth assets. This is where you hold your more aggressive investments. This is the money that can afford to be volatile because you don't need it anytime soon. And here's where the psychology becomes beautiful. When the market tanks, and it will tank, it always tanks at some point, you look at bucket 1 and you think, I've got 2 years of living expenses right here that aren't going anywhere. You don't have to sell anything in bucket 3 at a loss. You don't have to panic. You just wait. You let bucket 3 recover, which over long enough time horizons, markets historically do. I spoke with a retired couple, late 60s, both former teachers, who implemented this strategy about 4 years ago. When markets got rocky in 2026, their friends were panicking, selling, calling their advisors in a frenzy. This couple said they felt almost nothing. Mild curiosity, that was it. Because they knew exactly which money was safe and which money was playing the long game. The separation wasn't just financial, it was emotional. It gave their brain permission to relax. If you're not using some version of this framework, it's worth having a genuine conversation with a financial planner about setting it up. It's not complicated, but the peace of mind it creates is honestly kind of remarkable. Let me talk about something that doesn't get nearly enough attention, especially for people who are in that 5 years before, 5 years after retirement window. It's called sequence of returns risk, and it is legitimately one of the sneakiest dangers in retirement planning. Here's what it means in plain language. The order in which you experience market returns matters enormously, and it matters most right around when you retire. You retire and the market immediately drops 20% and you're withdrawing money to live on. You're selling shares at the bottom. Those shares are gone. They can't recover for you even when the market eventually bounces back because you don't own them anymore. You sold them cheap. This can permanently damage your portfolio's long-term health in a way that someone who experienced the same average return in a different order simply wouldn't face. Think of it this way. 2 retirees, same average return over 20 years, but one got the bad years first and the good years later. The other got the good years first and the bad years later. Same average, wildly different outcomes. The one who got bad years first can actually run out of money while the other one is completely fine. Same numbers, different sequence, different life. So what do smart retirees actually do about this? A few things. First, they go into retirement with a flexible withdrawal strategy, meaning if the market drops in year 1 of retirement, they cut back discretionary spending a little. They take a cheaper vacation. They don't do the kitchen renovation that year. They reduce their withdrawal rate temporarily, which means they sell fewer shares at the bottom. This isn't suffering, it's just smart timing. Second, they build in buffer assets, cash, short-term bonds, things that hold value when equities drop. We talked about this in the bucket strategy section. Same principle. Don't be forced to sell growth assets in a downturn if you can avoid it. Third, and this one I find really interesting, some retirees delay Social Security specifically as a hedge against sequence of returns risk. If you delay Social Security to 70, you get a significantly higher monthly payment for life. That higher guaranteed income means you need to pull less from your portfolio in any given year, which means in a down market, you're selling less, you're preserving more. The guaranteed income acts as a shock absorber. Okay, this one feels almost too obvious, but it's actually worth digging into because the research on this is kind of wild. There's a concept in behavioral finance called myopic loss aversion.
Basically, when you check your portfolio frequently, you see more losses. Not because there are more losses, but because short-term volatility means that over any given short period, you're almost as likely to see a small loss as a small gain. And here's the kicker. Psychologically, losses feel about twice as painful as equivalent gains feel good. So every time you check your portfolio during volatile markets, you are essentially signing up for a psychological experience where the bad days feel twice as bad as the good days feel good. You are volunteering for a negative emotional experience on a roughly daily basis. Studies have shown that investors who check their portfolios less frequently make fewer emotional, reactive decisions. They sell less at the bottom. They chase fewer trends. They just let their money do its thing, and their long-term outcomes are actually better. I'll be honest, when I first really sat with this research, I felt a little called out, because I've definitely been guilty of the compulsive checking. You tell yourself you're just staying informed, you're being responsible, but really, you're just giving yourself a lot of unnecessary anxiety with very little useful information to show for it. Smart retirees in 2026 have basically built themselves permission structures to step back. Some of them do quarterly reviews with their advisor and nothing in between. Some do monthly. But daily? Hourly? That's gone. They've made peace with not knowing the exact number today because they've realized that the exact number today is almost entirely irrelevant to whether their retirement is going to work out. Try this. Set a calendar reminder for a monthly portfolio check. That's it. Delete the app from your home screen if you need to. Give yourself permission to not know. You might be surprised how quickly the anxiety starts to dissolve when you're not feeding it every morning. This one is maybe the most personal section, and I think it's the one that goes deepest. For most of our working lives, financial security means a growing number. You save, the number gets bigger, you feel more secure. Makes sense. But in retirement, if you're still defining security as my net worth is high and going higher, you are setting yourself up for a very stressful time. Because net worth fluctuates. Markets go up and down, and you're now spending money, not accumulating it. The number is designed to go down somewhat. That's the whole point. The retirees who seem most at peace have quietly, almost without really announcing it, redefined financial security. For them, it's not about the number, it's about three things: income stability, spending clarity, and flexibility. Income stability, we talked about this. Are my essential expenses covered by reliable income that doesn't depend on the market? If yes, I'm secure. Spending clarity. Do I actually know what I spend? A surprising number of people enter retirement without a real, honest picture of their monthly expenses. When you know your number, like truly know it, anxiety drops considerably. Because vague financial fears are almost always worse than specific financial realities. Specificity is calming. Vagueness is terrifying. And flexibility. Do I have some room to adjust? Can I spend a little less in a bad market year without it wrecking my lifestyle? If the answer is yes, you're more resilient than you think. I think about a retired guy I know, a former engineer, meticulous, detail-oriented guy who spent 6 months before retirement just tracking every single expense, every coffee, every dinner out, every streaming subscription. He built a crystal-clear picture of what his life actually costs. And he told me that that exercise alone, that 6 months of awareness, was the single thing that most reduced his retirement anxiety. Not the market, not his portfolio size, just knowing his number with real precision. Because then the math wasn't scary anymore. The math was just math. All right, this is the section that might feel a little out of place in a finance video, but I genuinely think it might be the most important one. So stay with me. A lot of retirement anxiety isn't really about money. It's about identity. It's about purpose. When you've worked for 40 years, your job gave you structure, status, social connection, a reason to get up in the morning. And then suddenly, that's gone. And if you haven't filled that void with something meaningful, you can find yourself pouring your sense of self-worth into your portfolio balance. Which means every market drop isn't just a financial event, it's an identity crisis. I've seen this pattern over and over. The retirees who seem most rattled by market volatility are very often the ones who haven't built rich, fulfilling lives outside of watching their investments. And the ones who seem most unbothered are often deeply invested, pun slightly intended, in other things. Grandchildren, volunteering, travel, part-time work they actually enjoy, creative projects they never had time for.
There's research suggesting that having a sense of purpose in retirement is one of the strongest predictors of both life satisfaction and, interestingly, financial decision quality. People with strong purpose make fewer reactive, emotional financial decisions because their identity isn't riding on the Dow Jones. One woman I spoke to, retired nurse, mid-70s, told me she started volunteering at a local hospital 2 days a week after retiring. She said it changed everything. She still had purpose, she still felt needed, and she said something I've thought about a lot since. When you have enough to live on and something meaningful to do, the market just becomes background noise. Background noise. That's the goal. Not indifference, not ignorance, just perspective. One more thing before we wrap up, because I'd be doing you a disservice if I didn't touch on this, especially given everything that's happened with prices over the last few years. Inflation is real. It's not imaginary, and for retirees on fixed incomes, it genuinely erodes purchasing power over time. I'm not going to pretend that's not a real concern. It is. But here's what I've noticed. There's productive worry about inflation, and there's unproductive panic. Productive worry leads you to ensure some portion of your portfolio is in assets that historically outpace inflation over time. Equities, real estate, treasury, inflation-protected securities. It leads you to review your budget periodically and adjust. It leads you to think about whether your income streams have any built-in cost of living adjustments, like Social Security does. Unproductive panic leads you to make sudden, dramatic changes to your portfolio, to flee to cash, to try to time the market, to lie awake at night catastrophizing about a future that hasn't arrived yet and may not arrive in the form you're imagining. Smart retirees in 2026 have basically internalized that inflation is a known, manageable variable, not an emergency, but a thing to plan around steadily and calmly. They've built portfolios with some inflation protection. They have some flexibility in their spending. And then they've made peace with the fact that a little uncertainty is simply the price of being alive in an economy. You can't eliminate inflation risk. You can only manage it thoughtfully and then let it go. And honestly, that's true of most financial risks in retirement. You can't eliminate them. You can only plan sensibly, build in flexibility, and then, and this is the hard part, actually let go of the rest. So let's bring this together, because I don't want you to walk away with a list of tactics and no real through line. The retirees who've stopped worrying about the market in 2026, the ones who seem genuinely at peace while the news is loudly insisting that everyone should be panicking, they didn't get there through luck or through being exceptionally wealthy. Most of them got there through a series of quiet mental and practical shifts. They started thinking about retirement as income, not just a number. They organized their money in ways that reduced their emotional exposure to short-term volatility. They stopped checking compulsively. They got really clear about what they spend and what they need. They built lives with meaning that didn't depend on a portfolio balance for their sense of worth. And maybe most importantly, they gave themselves permission to not have everything perfectly figured out, to accept that some uncertainty is simply part of life, that you can plan thoughtfully, act wisely, and still not control every variable. And that's okay. I think about my mom in her garden, not because she's naive about money. She's not. She's careful and intentional, but because she made a decision somewhere along the way that she wasn't going to let the market decide her emotional state, that her retirement was going to be lived, not monitored. That's the shift I hope something in this conversation sparks for you. Not a specific portfolio move, not a new financial product, just a quieter, more grounded relationship with your money. One where the market is a tool you use, not a force that controls how you feel.
You've worked too hard and too long for your retirement to be spent anxious. You deserve better than that. And the good news is, you can actually get there. Not by ignoring reality, but by seeing it more clearly, and by deciding that your peace of mind is worth protecting just as much as your portfolio. Take care of both. You'll be glad you did.